You're good.
All right, cool stuff. All right. Hello. Welcome to another meeting for the investment club. All right. Really quickly, any questions? Anyone want to ask something? Always open up with a question. I'm not sick with COVID, by the way. Got the general cold. I took 3 different tests. Anyways, all negative, except for that last one. I'm kidding. All right. All right. Another thing is, if you find anything useful here, please recommend this to your friends. We are all financially literate because they don't teach us this shit. So please, if you find something meaningful, do know that your friends will most likely as well. So help your friends out. 3 things really quickly. This is all given for free, the information here. So if you benefit from this, please do consider donating to these 3 different charities that I found, which are really good. Charity Water, Austin Pets Alive, and World Central Kitchen. Yeah. And to give that really cool, like, you know, just because, like, fuck yeah. The world is better when we care together. All right. Okay, so market update. All right, so let's talk about what happened here on a technical analysis level as well as a macroeconomic level. Today we bridged down a pretty significant level here. From down here below, we had a swing high, if you will. It's a general sort of terminology that's applied to these sorts of larger swings. We're in a bear market, so these bear market rallies can get really crazy. And we broke down below here. Now this first of all, coiling. When you look at it, volume, and you know, we won't get into that so much, but what it basically means in a nutshell, when I reference volume shelf profiles, is when there's coiling that happens, and you'll see this, you know, elsewhere. What happens is that there's a bunch of shares being traded in this area, and when you break down sort of a basic element to technical analysis, when you break down below that area of like where there was support, right? We would see that. It becomes resistance. That's what happens. Now, you can have false breakdowns and those sorts of things. Those are always possible where like it goes down and it comes back up. You know, those things are possible. But generally they're actually kind of on the rarer side.
I have a quick question. Is there, looking at the end there, is there a gap at the end there that needs to get filled, that'll probably be filled?
A gap like here?
No, on the last 2 candlesticks. I can't really tell. Is there a gap between those last 2 drops that could eventually get filled, essentially?
Yeah, okay, so gap fills are usually like this, where even the wick is apart from it. That's pretty close, but it's not so close. So that's kind of, this is a good example right here. That's a gap. This right here and that one right there. The wicks are just not even close to each other. When you see overlapping wicks, generally that's not going to be, I mean, I just don't think I've ever seen where that's like, oh, hey, look, a gap fill happened, where it comes back to that sort of thing, where it's really like, recognizes the gap. That doesn't happen.
That makes sense.
It's like that. There's just no overlap whatsoever. Yeah. This happened on some pretty big economic news. What happened was that England ran into trouble with its pension funds. What happened was that companies were being stupid, and they leveraged the pension funds that they had buying derivatives, which are options, right? Just, you know, leveraged products there, leveraged tools. And they collapsed. The bonds just shot down, I think, like 40% in like one day. And that's interesting. I mean, we can get into all the complexities of that, but just in a nutshell, they fucked up. And so what happened was that the Bank of England had to reply with, we're going to have to go really quickly here with quantitative easing and take away from the restrictions that we've been putting on, you know, quantitative tightening. That gets into some other stuff, but just, you know, think of the federal funds rate, right? That, you know, when we quantitative ease, that plummets, right? So money is easier to get, that sort of thing. So they had to do that really quickly. There's a couple problems with that. First of all, the world is trying to tighten right now because inflation is so bad. If you have, which is true, this England is the 5th largest economy in the world. When they do that sort of shit, we are so globalized that has implications for other countries. Quantitative easing hurts our attempt to try to rein in inflation. It causes inflation. They're needing to do this. And then on top of all of that, on top of that fact, when their situation is sorted, they will have to respond doubling down even harder on their federal funds rate, their version of that, because they just went through quantitative easing, and that's gonna fuck up their situation. So it's throwing not only problems like that, but also just a general unknown into like the picture right now. So classically, what's happened, we got a big breakdown. And so from here, as per technical analysis, what may very well be the next line, if I can get this here, I might have to go to weeks. The next line of support, if you will, would be the 50% retracement level over here. And you can see, and again, looking at a technical analysis level, right? What's here? What's going on here? Not a lot. This coiling, this is good, right? That's why there's support there. That's why we can look to this level of area, right? But there's nothing here. So now that it's broken down, there's nothing to really catch it. Not until here, the 50% retracement level. So I just want to point that out. And also, as time has gone on,
Is this the SPY?
yes, this is fine, yeah. As time has gone on, something important has happened. And I'm going to talk about the nature of what we're looking at here. So this is HIBS. Now we've talked about HIBS before. Market's crashing. I've personally invested in HIBS, another one as well. And I made this decision, both being right in making that decision as well as wrong, and I'll tell you why. What's happened is this. As far as the price action, what literally just happens for a stock price action, is concerned, what we're seeing is something that's called a megaphone pattern. See how it goes down and up, right? It's expanding, kind of evenly, right? It's a megaphone pattern. That's problematic. The reason why is because if you're trying to hold this for any sort of elongated period of time, a few months, a year, a couple of years, whatever, right? That's going to cause problems. The reason why is because, as we see right now, what the SPY looks like.
So you basically here you're talking about the increased volatility, essentially is your point, or am I missing?
In a sense, yes. In a sense, yes. What I'm trying to say is this. It's problematic, and the reason why is because given volatility, and you saw the SPY where it had, so
What
this
is
the
HIBS
inverse.
is HIBS a leverage short?
Yes,
Okay,
yes,
that
the
makes
inverse
sense then.
is, yes, it's the inverse of SPY.
Gotcha.
This is where, if you remember that big, swing high that I showed you earlier, right? That's the first part of the bottoming of that. So, I know what that looks like in my head, but I'll just show you again really quickly. Okay? That's what I'm talking about.
Yep.
Right, that low there. You see how close we are? We're really close. In fact, actually, we're a little lower. Now go over to HIBS. What happened? Right? We're a lot lower than that. Now, that's the nature of these because it takes a little extra in order to go higher than where it was before, right? Just by the nature of how these things operate. But the part that was, before I get to that, why this is problematic is because of this. If there is not enough of a direct crash, what can easily happen is an evening out over here and a continued downtrend over here. That's just what can happen. That's just, it's just one of the possibilities. That's a problem because if you're holding, these highs may continue like flat, or they may go down even, and the lows will keep getting lower and lower. That means over time, you've got less and less money to you. Here, that's what went wrong. What went right was this. You look at the ratio between the very bottom here and the very high here, it's like 1.7 times or something like that. Now check this one out. This is SPXU. You see that difference? It's almost the same, right? Again, it's not just a little over because of the nature of these things, but as we continue crashing, because there's that trend downwards in the markets, this will be able to take advantage of that. It'll be able to, by the nature of itself, it'll be able to go higher than this, in some short amount of time, I do believe. As we have a crash that's going on, right? There's a direction downwards. Takes advantage of that. This looks nice. Look at the trendward, right? It's going up. Oh, I like that one. That's going there too. Nice. All right, good shit. You know what's the problem with that one? 1.6 times. 1.6 times. The other one's 1.7. The ratio is better for the other one. But if you're holding, this one's better. Why? In particular, because look at the downward, the bottom support area. It's going up. You're holding this for any sort of amount of time, your money will continue to increase.
So it essentially, because of the decrease, however this short is set up, it has decreased volatility, so you're not hitting as low of lows, and that way you're actually able to average out a gain. Is the idea essentially what you're getting at here?
Yeah.
With the other one, you're hitting such deep lows that it starts to get pulled into that. Versus this one, it's not able to dip quite as much past that support level, just because of the structure of the ETF.
I think I'm pretty accurately covered the picture there.
Okay.
This is in balance in such a way as it is set up, you can say. I mean, it's obviously you're talking about complexities here, but we'll just say in balance, shorthand. In balance in such a way where you will not have what we call volatility drag, right? This is continuing to go up as the market's crashing. This one, SPXU SPXS. If you are in HIBS, get out.
Okay.
Get out of it, I would say pretty soon here. I'm looking personally to the 50% retracement level. I think that's a really good area to think of support, because again, I showed you. And get into, I would say the replacement is XPSU, XPSS. And I'll have that in the description there of the tickers of those things, right? And the fuckers, so on this platform. Search right there, SPXU, SPXS, it'll pull that. And then finally, talk about England really quickly. So, like I said before, to indices, right, SPY. This happened, we had a massive down day, just recently here, and we had some other bad news as well. I think so. Sorry, I'm having a brain fart right now. Point is though, is that very recently what happened in the last day before today, at least what happened, and we had some other, anyway, so.
Well, it was the Nord Stream pipeline definitely bombed the markets too.
Yeah, exactly.
So there've been a couple really major things recently. I mean, the Fed gave a speech last week, I think, too, that moved the markets down.
Yes,
I mean, there's been a ton of shit recently.
That's what I'm thinking of. Yes. What happened is that they had a talk that came out. Where is it? It was like a math. Oh, there it is. That's the day I was thinking of. Yeah, 4.35% down. That's massive. A big day down in the markets is usually like 2% or something like that. So it was 4.5% almost. And that on that day, what happened was the Fed got very, very hawkish, and they've continued with that rhetoric, saying that we will not stop, and until at least we're planning until like early next, from the different like Fed members to like early next year. And in that context, make sure that you understand when they say that, it means they're planning out for at least that far, not to say that they will actually stop then.
Yeah.
It's just that that's their.
I think it's fascinating too. I mean, what they're talking about. He's the head. I can't remember his name off the top of my head now.
Jerome Powell?
Yeah, Jerome Powell.
Yeah.
He's been coming out and saying specifically what he's going after is the wages. He thinks that driving down wages is the way to stop
the
inflation and stuff.
Right?
And so I think what's also fascinating trend is when you look at like the employment numbers right now, the labor market's starting to tighten up again a little bit. So it's not working. Like his plan is not working. People are not just taking a job at lower pay and reducing their expenses. They're just not working. So it's like you have this sort of the labor issue plus the Federal Reserve's actions are really clashing right now.
Yeah, and that's only going to spell higher for the federal funds rate, and that'll continue to crash the markets.
Yeah. I mean, mortgages hit 6% today.
Huh?
Mortgages hit 6% today average.
What
the mortgage hit 6%
the mortgage, yes,
today.
right, exactly. Yeah, that's time. Yeah, so combined factors. England, what's going on with China? The real estate market is crashing badly because it's fucked. Evergrande, a bunch of other ones came out, a bunch of cockroaches. I mean, literally, I knew it was like a Lehman moment over there.
China's gonna back that up, though.
Huh?
Don't you think China's gonna back that up? Like they're just gonna.
Maybe.
But
the problem is,
they're gonna kill the president of Evergrande or something like that, and install a party member in there, and then they're gonna just fund it with a couple billion. That's what I think most of the analysis on it's been. Is they're just getting rid of the CEOs.
It might be like that. On top of that, there's problems with concerning that because if they try to just bail people out, then being communist also as capitalist, what's actually just straightforwardly happened from the lack of action.
Well, new home construction is super down everywhere. New home construction is down globally and really down in the U.S. right now too.
Yeah.
So I think that's a big driver in it too. It seems like. Also, if I'm talking too much, let me know. I'm just trying to.
No, I get you. Yes, it's multi-factor. Anyway, so important point on technical analysis. Rebounds. There's. We'll talk about that probably next time, but just know that there has very recently, when you look at momentum indicators, there is positive divergences, which just means that there is strength building the market. But that's going to happen very close to the actual bottoming. And again, I think it's just going to go right to the 50% retracement level there. And let's see what level specifically that is at. Here at 342 on the SPY, 3,420 something, on the SPX, which is the actual index, it's just the ETF that follows it. Anyways, all right. Well, that's really all I want to do. And then Forrest here from the Entrepreneurs Club, X. Literally used to be there. So point is, he knows some shit. He's gonna go over retirement tools. I'm gonna be making notes myself. Please give a warm welcome to Forrest. Yay, Forrest! Woo!
Thanks. So I agree with pretty much everything he just said, but this presentation focuses on a completely sort of different approach to investing. We aren't gonna do any sort of technical analysis. We're not gonna look for support levels, anything like that. Personally, the way I kind of invest, I started doing this during COVID. I learned how to value invest during COVID, and I'll be sharing all the resources I learned from right at the end and everything. I like value investing because, to quote Buffett, you get to sleep well at night. You don't have to worry about, some short trade you've got going or some options deal.
And mind you, value investing, right? I mean, he'll explain here what exactly he means by that, but that certainly overlaps with long-term investing.
Exactly.
Which is
it's a long-term plan. You don't really,
precisely.
you don't trade off of value investing.
Not day trading.
And so, there's no trading involved. Basically, I mean, that Warren Buffett quote at the top, I put that there because I think it really embodies a lot of, the ethos of value investing. If you're not willing to hold that stock for 10 years, you shouldn't hold it for 10 minutes. The idea being, you want to be in stuff you're just completely comfortable with, causes you no anxiety. Why worry about your money when you've got better things to do with your life? And so that's where I'm eventually trying to get to, is that I don't have to worry about my money. So basically, if you're asking kind of what is long term, in all honesty, I mean, it's 15 to 45 years. Ideally, if you get in good with a great company and hold it for 40 years, that's how you make those 100, 200, 300x returns on an Apple or an Amazon. You have to hold that for 40 years though. It takes a long time to make those massive gains. You see, if you're going to do it systematically, you see it by luck in the short-term traders where they swing trade and stuff. But if you want to do it based off a process that almost not guarantees it, but it guarantees a level of safety to it, this is sort of the best approach in my opinion.
And if I can just add really quickly that, keep in mind in that picture, guys, I'm behind the camera here, you can't see me, but hello, that trying to pick specific stocks, and I think you go over this, that index funds, is generally going to be the better way to go about that. And in that picture as well, as I showed you guys this before, and what that video is kind of a while ago, but there was a guy who was able to calculate the differences in gains between just the SPY and also a leveraged SPY owned long term. We keep talking about this again, and the differences over past 100 years, something like that. It was some initial paltry amount, something like that, $1,000, $10, 100, something like that. And the end was that the SPY had gone to $500,000, and the leveraged version of it went to 13 million. So in this context, understand that the ideas certainly overlap of index funds, grouping of stocks, as well utilizing, I think, leverage products can certainly give you, in a long-term sense, a great deal of edge. Just keep in mind bubbles, massively bad news, and we can talk about more of that into the future. Certainly people want to. So, yeah.
I mean, essentially what I think you're trying to say is, if you wanted to make it the most simple way, you could just invest $100 a month into the SPY for 40 years, and the math basically works out on historical return, the historical return that the SP has had.
Yeah.
You're going to end up close to $1 million in 40 years. I don't think you actually hit the million now, but you get pretty damn close.
Yeah.
So that's just basic investing, right? That's just throwing money into the market and dollar cost averaging. What value investing does is it takes a little bit more of a look at some of these fundamental metrics, stuff in their 10Ks. What is this business actually? How healthy is this business truly? And by doing that, you can squeeze a couple extra points out of the market. And as he's saying, a few extra points over 40 years can be huge.
Because yes, compounding interest, the eighth wonder of the world.
Yeah.
From Albert Einstein, who said that.
Do you have a question?
Yeah, how much did you say you invest in the S&P 500 in 40 years or maybe not?
If you put the math works out, if you did $100 every month for 40 years, you get close to $1 million.
Yeah. And again, keep in mind the reality that those leverage products that I talked about, in a sense, yes, it's riskier because the downturns can certainly be and will be more bloody if you do not have a viewing on what are valuations currently and
we're going to get into valuations.
Yeah.
That's what's key, is basically understanding what things actually worth is very key in doing this.
Yeah.
One really quick note on this though, I don't know a lot about this, but it's definitely something that I'm looking into currently for myself. Just as I'm losing my parents' health care at 26, HSAs, they are a way for you to invest tax-free and use those funds for your health needs, and especially at a young age, getting a high deductible plan allows you to participate in the SHAs. I'm just starting to learn about this stuff right now, so I don't have a ton of info, but I would definitely recommend looking into high deductible insurance plans and contributing to an HSA if you're 26 and about to lose your parents'
and there's other accounts out there for education. We'll be going over that in another meeting for those various sort of accounts, but for right now, it's just retirement tools.
Yeah, and I think the HSA is just sort of an interesting one because it is a bit of a retirement tool that young people can utilize. allows you to draw out of it sooner if you have to, if you break an arm or
Yeah.
something.
Yeah, exactly. Yeah.
It's a little bit more flexible in the Roth, which is why I sort of wanted to make that mention.
Yeah.
So the primary thing that you kind of have to understand with value investing, it comes down to this metaphor of Mr. Market. And so it comes out of, Benjamin Graham's going to talk about it in that book. I think someone else even talked about it before Graham did, but I sort of, for some reason, think it was Benjamin Graham's invention. It's this metaphor of the stock market that he's an alcoholic schizophrenic. He's driven only by fear and euphoria, and he invests based off of his mood. So he's going to come to you one day and say, hey, this stock's worth $1,000. Next day he's going to come to you and say it's worth 10. Next day he's going to come and say it's worth 50. Fourth day he's going to come and just for shits and giggles at 69.69. Then the next one's 66. Like, he's just random. So what your goal becomes, you're not trying to influence him. You're not trying to understand him. You're not trying to predict his mood. He's going to come to you with a handful of stocks every day. Your job is to pick the one with the best intrinsic value. That's how you kind of involve value investing with dollar cost averaging and make a system out of this.
And to just add on that, it's certainly not a bad idea to learn about value investing. I'm sure it is definitely going to have its place, and it will be something that can benefit you. But to keep in mind that this is going to be more so for the fact that you have another tool now to be able to analyze and understand the stock market, and in the very least, you will always be able to fall back on the SPY greatest collections of consistently successful businesses.
Yeah.
And I think I remember seeing a stat out there that somewhere between 80 and 90% of hedge funds consistently fail to beat this S&P 500.
Oh yeah, I mean, most investors who pick their own stocks, even commercial investors like us, we mostly fail to beat the market. It is fucking hard to beat the market because you make bad choices. Your stock's going up and you want to hold it. That's when you should have probably sold it. Yeah. So especially with the robo investors that they have now, like, it's getting harder and harder to beat the market. And Buffett's even said this. He's like, it's getting tougher and tougher to just beat the robo indexes.
Yep.
But essentially with value investing, there's a ton of stocks for sale every day. Like, you can find some crazy good deals. The screener I use is called FinViz. There's quite a few out there. I believe Webull has theirs.
Yeah.
We're gonna go over some metrics in a minute here. The idea is, I once got into Bank of America when it was trading below its cash value, which basically meant for every dollar that I invested, or every 75 cents I was investing, I was gaining access to $1 within their pot of money. So they were trading below their literal cash value. That's a great intrinsic value investment right there. That's been one of my best ones. So dollar cost averaging, we already kind of did this. Just the idea that you're not going to invest everything at once because you're not trying to predict his mood. You're not trying to say, oh, I think this is a great time to invest, I'm going to go all in. You're going to say, I think this is a time to invest, because it's always a time to invest. So I'm going to invest my regular sum every month, and I'm going to pick the best option available. The key to this whole idea of long-term investing is it's a game of averages. You don't want to rely on your emotions. You don't want to rely on your own decision-making. You want to create a system that will statistically result in a positive.
Yeah, and it is it works for a number of different reasons, because you get a paycheck. So by the very fact of where you're getting your money from, the dollar cost averaging and these repeated time sort of investments is going to exactly be in line with your life anyways. And on top of that, to be able to time, again, it's like lump sum investing just here, this one-off, terrible idea. You gotta chunk shit up, and over the long term that will work out certainly for favor. Even though there are tools out there like cycle analysis, Steve Miller, again, I've talked to you guys about.
And we're gonna get into that, because the whole idea of value investing is not just to throw it in. Like this example kind of is, if you were just gonna throw it into the market, that's what it would look like. Yeah. What he's saying is by doing some more extra analysis, looking at the cycles, I don't do a lot of technical analysis, but I do a little bit here and there. Yeah. And you can do technical analysis to help your fundamental investing. This stuff we're doing is called fundamental analysis, where you're looking at their metrics and their 10K and their balance sheet and all of these types of things. It's a little bit more like bones and flesh of the business. Yeah, which is very important. So that's why I tend to rely on it a little bit more. But I've missed a ton of short-term opportunities. Like, I know Jacob's taken way more advantage of some of the short-term market volatility than I have over the last year. Yeah. It all depends on your style. I think, combination of it's good. Like, I eventually want to learn how to trade a little bit more because I'm pretty good at this. So I think, everyone should invest in everything. You should be doing real estate. You should be doing short-term trade. You should be shorting stuff. You should be doing long-term stuff. You should be putting long-term, should do it all. Yeah. So the biggest ratio that you're going to hear about with value investing is going to be your PE. Probably heard about it in business class, price per earnings per share. It's just your brute metric, and basically you can get a lot of info out of it though. So if you're really just trying to do a quick and dirty investment on something, you can just compare PE ratios within an industry industry, you actually have a relatively high rate of success if you just pick the one with the lowest PE within the industry, as long as there's no other red flags. So PE is, I mean, it's not exact, but it's a very brutal metric that gets you a decent understanding of how healthy the business is very rapidly. The other tools that I really like to use: price to cash, price to book, price to free cash flow, debt to equity. Price to book doesn't seem to be as big anymore as it used to be. People back when we had a lot more like inventory companies in the US used price to book a lot more then. But since we don't do a lot of manufacturing anymore, people don't really do that quite as much. The one I really actually like is price to free cash flow, because the way I think about it is which company has the higher price to free cash flow, they have access to more cash to reinvest in their business at this time than their competitors do. So as a in this moment metric, I personally really like price to free cash flow, and then I just set for debt to equity, I just say like there's a certain rate at which point I'll stop being interested. If you have too much debt, I'm just not interested.
Yeah.
The reason I bring this up is that I already mentioned this, I got into Bank of America when they were under their cash. For whatever reason, the market had just taken a shit on Bank of America stock, and they were trading where their price to cash was below 1.
By the way, when did that happen?
That was in like 2021, I think. I should look back and see when I actually bought that, but I want to say 2021, maybe 2020. But it was like a 48-hour window. They traded at it for 2 days for some reason. So a couple other people started to pick up on it, and then they had like a nice 20% bump right off the bat, and then Buffett put in a couple billion right after that because it was also just like the metrics looked good, and we're going into a recession given the bank. So
Yeah.
I'm up over 100% on it right now, and the market, even with all these crashes, I'm still up 100%. But that's because I bought it at such a great intrinsic value that I don't have to ever worry about my Bank of America stock ever. Like, it's about $1,000. It just sits in that account, and if it ever crashes hard, I might even buy more. But for the most part, it just sits there and earns me a nice little dividend. Diversification. So we already mentioned index funds. You shouldn't be touching mutual funds in your 20s for the most part, in my opinion, just because of the increased fees.
Yeah,
Jacob might disagree, but
yeah.
I'm not a big fan of mutual funds, just because they tend to incur higher fees.
Yeah.
Index funds are the way to go, in my opinion.
Yeah, and again, to keep in mind, like, first of all, what is a mutual fund?
They're older tech too. They're an older financial instrument.
Yeah. And a mutual fund is basically, think of an index fund, right? It's just a collection of different, regularly high performing stocks, like the SPY, right? It's based on the SP 500, but it's like more, you would say, handled, and there's more interference. And I've seen very little evidence to support the idea that mutual funds do better than just like the SPY, and they just seem like a shitty
They
fucking
really don't.
instrument.
I mean, the only time where I would maybe consider a mutual fund, if you are nearing retirement and you want to do some sort of very safe, where you're divesting at a very slow rate with some sort of bond mutual fund, like maybe then mutual funds might make sense in retirement. But
Maybe,
for people in their 20s, I just personally think that they're not a great way to go.
Yeah.
Obviously, Jacob seems to agree. So then top indexes, SPY, ARC just had a really big shit day like recently, so I mean they are very low. IBB, QQQ is a leveraged tech one. BTO, I believe that's a inverse. I think BTI is an inverse too. And then SMH is a really interesting one. That's a semiconductor, a US semiconductor ETF. That's actually been performing really well over the last year. It's in a bit of a dip at the moment, but I personally invest in SPY for the most part if I'm going to go for an ETF, but I'll occasionally do SMH as well.
Yeah.
And allocation is key, so you should always look in to see what the allocation actually looks like. Don't invest in one of these products that are grouping a bunch of companies together without actually seeing where it's at. So there was one point where the S&P was like, it was like 20% Google and 20% Tesla or something fucking crazy like that, where it's like you're really just basically investing in Google and Tesla. It's not actually that diversified at that point. But it was a really brief period, but it's definitely always looking at the allocation. So one of the biggest things with investments, you kind of have to be honest with yourself about what your goal is. Are you trying to make a buck with Bitcoin? Are you trying to jump in on the Bitcoin? Do you feel the FOMO of the market where everyone's making money and you're not doing it and you just want to get in? Is that what you're doing it for, or do you actually have a plan? You have to figure out what your time horizon is. If you want access to the money where you could withdraw it if you need it, there's no shame in a brokerage account. Just be prepared for that tax burden. And in my opinion, long term is far easier than short term trading. It's a lot easier to learn. It's a lot easier to do it well. And it's a lot easier to just not worry about it and know you're doing it okay.
Yeah, and it's a lot easier to actually have gains.
Over the long term, like not always at a moment to moment basis, but on an average level, statistically, if if you follow certain rules and you stick to those rules, statistically you're gonna be okay. You'll come out ahead. Like, it's tough to guarantee that the average market return is gonna stay for the next 2 decades or whatever. Like, we've had 2-decade periods where it returns really low or really high or whatever, so, we're dealing with historical averages, it's a game of stats and averages, but in terms of a long-term approach, this is the way I've learned it this way, and I think it does make sense.
Yeah.
So what sort of account should you choose? The base question essentially here is Roth versus traditional. 401ks are offered by your employer, so that's the only way you can get a 401k is through work. If you're self-employed, you can have a 401k and you can have an IRA, so anyone can have an IRA. I recommend just, even if you have a 401k, go ahead and get an IRA because they're more flexible. 401ks you're generally picking from like predetermined, basically a lot of times mutual funds too, or indexes, so you're just picking their pre-prescribed investments for you. What the IRA will allow is it's going to give you a lot more freedom.
For you to choose.
Exactly. Same sort of deal with the HSAs. I believe they're more similar to the 401ks where you're kind of picking from a prescribed set of options, but I've just been learning about this recently, and I really think there's a lot of potential for people who are turning 26 and about to get kicked off their parents' insurance or kids at our age. I think that we should really learn more about HSAs. It seems like a very powerful tool that could really help people avoid some taxes in their young age, and it makes the insurance stuff work a little bit better.
Yeah, it's a great little tuck away for like emergency funds because it's for your health. So it is definitely good.
But that honestly, to me, that deserves its own 30 minutes, so I don't even want to go into that one too much.
Before you actually move on, let's try to define some stuff here. So,
I didn't
at least
go
expand.
traditional there.
Yeah, expand on some of the pictures
Yeah,
here.
definitely. So I can do it.
Yeah, go. You can go for it, and I'll see if I can
Yeah,
add some stuff.
it's pretty simple. Roth is post-tax, traditional is pre-tax. When you're signing up for an IRA, you get to pick which one you want, and a lot of that just comes down to how much money you're currently making. Do you expect to make more money in the future when you're withdrawing, or less? As a student, currently, I expect that my income will be higher whenever I'm touching this account, and so I want to do it post-tax. I want to pay my taxes at a low rate right now, invest them, get all those gains, and then not pay those taxes later. If you were very wealthy, currently making a lot of money, you might want to go ahead and go the traditional route and do it pre-tax. Maybe your tax rate will be lower once you're just drawing off Social Security or something. So to me, the way I view it, I think Roth is better when you're young, traditional is better when you're in an established career.
Keep in mind something that's quite important. I might have done this myself a while ago, but I couldn't quite remember, because it varies inherently anyways. You can try to calculate, based off, market averages for, 7, 6% or, whatever you want to do. So, okay, so what I'm talking about is this. Is it truly a benefit for you to pay taxes now and then not later? Because what inherently is going on by the very fact of compounding interest is that you are taking away actually quite a significant amount later because what happens. So you're going to have to figure out because it is going to be relative to what you think and understand for yourself in terms of your earnings later on. But you can go ahead and you can calculate that stuff out, and it will vary. And sometimes it will be the better idea to do with Roths or to do traditionals. And so it is going to depend like that. And personally, I would kind of lean towards a Roth IRA because again, it's just the compounding of your investments is just it's gonna be pretty wild. So you'll take that.
Especially.
Yeah, exactly.
If you're in your 50s and 60s,
right, then it won't matter that
making
much.
$1 million a year, honestly, it's not going to matter. But even at that point, maybe you want to go with the traditional. But at that point, it's even not even.
Because of the lack of the time horizon. So chances
you
are.
have to consider the fact that you're giving up value, right? When you pay with post-tax, you are actually losing a little bit of money now, and the time value of money says that you should consider maybe I could have taken those tax dollars, invested it, and maybe it would have worked out. It all depends, and as he's saying, you can do the math on it yourself, and it gets very complex. But to make it simple to me, I just say, even if you have a 401k through your employer, get yourself an IRA, and if you're young, get it in a Roth. That would be the way I would phrase it, just to make it as simple as possible. That'd be across the board. That's on average, that's the best advice.
Sorry, just to clarify here, are you saying that the Roth IRA is when you pull out the money in some decades, that's when you get taxed?
No, you won't get taxed.
You won't get taxed.
You paid your taxes when you put it in. You're gonna then take you take your income. It's just whatever's in your bank account. That's what you invest into your Roth, right? And then you get credit that all depends when you're gonna get that tax credit, essentially.
Uh-huh.
And so you get the tax with the Roth, you're gonna get that tax credit right away, and that's where you're basically paying money, you're paying your tax on it by, getting the credit, you're actually paying the money.
Yeah, sorry, I could have sworn that was the other way around.
Let me double check, but
I
I'm gonna
really
just Google
thought
this
so.
to make sure.
I could have
but
sworn,
I'm gonna
dude.
Google it now that you're saying that.
Yeah,
I looked it up before this, so.
So while he's doing that, let me tell you guys really quickly about 401ks too. What can happen is, and you have to investigate, ask your employers, is that they
Definitely
can,
ask your employer.
yeah, and they can, again, some stuff will be, predefined, so you can figure out like if that's really something that you would want to do. I personally don't really recommend so. I like the freedom. I don't think a lot of employers are being like, unless they do allow this, leverage ETFs and stuff like that.
Roth, you contribute your post-tax dollars and the money grows tax-free. With the traditional, you're gonna be contributing pre or after-tax dollars and your money grows tax-deferred, so you're gonna get taxed when you withdraw it. So traditionals are where you're gonna have a tax burden at the end.
Yes.
You already paid.
Okay.
Yeah, you get basically if you contribute to a traditional, you're gonna get like an extra bonus on it that year on your taxes because like you get a benefit from contributing to any Roth. So that's just that amount that you contributed is the tax write-off in and of itself. But then with the traditional, I don't have a traditional, so I don't exactly know if this is 100% how it works. But my assumption would be essentially your write-off would be that amount with your times your tax rate, and then you got one point tax rate.
Sure.
Because it would basically just add a little bit extra. I don't know if that's actually how the IRS handles that, but I just confirmed for sure the Roth is with post-tax dollars, and however it works out with your taxes, you end up, obviously you're using your own money that you already pay taxes on. So it's all this game of fungibility of money, right?
And
But with the traditional, it does work out to where essentially you didn't pay taxes on that money.
And keep in mind, if you have questions about this sort of stuff, you can go to your bank. You can even call up TurboTax or something like that. But
I mean,
Of course
I
not.
call Fidelity all the time and ask them
yeah,
questions.
exactly. Yeah. So there are resources out there that you can call and you can ask them questions, and so I would totally recommend that. One last note about the 401k is that your employers can match contributions generally up until like a certain limit of like so many dollars.
Always get your match.
Yeah.
I think personal. We're gonna kind of talk about this in a moment, but personal finance is a big part of it when you invest, and just getting that. If you should be having some level of savings and getting your match, and then you're ready to invest. Like there are steps to get you to the point of like a long-term systemized investing plan like this. Because again, this is for the long term. This is actually after you've already got quite a few things in place in terms of your personal finance. But essentially, where should you establish an account? I personally use Fidelity. Schwab and Vanguard are great as well. And then if you want to use some of the newer ones, Betterment, Fundrise, Webull, and yes, Robinhood all do offer Roth IRAs. I am not as hard on Robinhood as other people are. I kind of like them. And then this is sort of a big page here, but the dirty secret is no one cares about your money but you. All of this information is publicly available online. You should never have to pay for any of it. You should explore all the resources that are available to you. And honestly, just reading the IRS tax code is boring as shit, but it's really informative. Again, always consider your sources, do your own research. All this information is PowerPoints for entertainment purposes only. It's not meant to be interpreted as financial advice. Persons are encouraged to do their own research and disclose research. For the resources, I really like the Investing for Beginners podcast. It's a really simple breakdown of kind of a lot of the ideas we talked about. They touch on a lot of different things too. If you want to understand what is money on a more metaphysical level, the What is Money show is amazing.
Oh yeah.
I think don't you listen to that one at all?
I don't know that one, but I can.
That one that just to you personally. I think you would love the What is Money show. I think that's the one that you benefit from listening to the most.
No, fair enough. Yeah.
Earn Your Leisure is great. They cover a ton of different topics. If you want to learn how to start your own food truck, they do so much on Earn Your Leisure. The guys over there who run that, they also run Market Mondays. I mean, they're really taking off. They're getting into Forbes. They started during the pandemic, and they're this financial education company, and you for sure need to look into it.
Cool. Okay.
They're getting big, and they're getting invited to banks that Ian was at Facebook today, doing something, having a meeting with someone at Facebook.
That's cool.
It's crazy.
Yeah.
Market Mondays, if you had to pick one resource for investing, that's the one I would go with. They literally will give you stock prices to look for. And Ian posts his receipts of hey, this is the trade I told you to make, here's what you would have earned. So I just, that would definitely be the top one. Those last two are just sort of what they are. the top book I would recommend would be actually the little book of value investing, just because it's so short, it's such an easy read if you want to just get an understanding of all these topics, what price to book actually means, what price to cash actually means, price to earnings, all these ratios we went over. It's like a 75-page book, very easily written, it's in like big text, it's super awesome. Definitely read that one, and if you want a more in-depth look, The Intelligent Investor is great, and if sort of more in the vein of Value Money, Sent Money by Nigel Ferguson is great too. In essence, the whole idea of value investing is you have to get to a certain point where you are okay, you're gonna say, I'm just taking $50 a month and I want that to grow. I don't care how it grows, I just want it to grow. And so once you're financially secure enough that you can do that, you can create a system that over time will average to a point where you can basically expect a positive return. The problem I have with short-term trading is there's no guarantees like that on a statistical level, and a lot of the evidence says you tend to lose more than you win.
Yeah, you lose money.
The house tends to win if
Right.
you don't have a real system. And so what this long-term investing and value investing allows you to do is get a few points up on the house, and over the long term, hopefully you win and no one loses unless they guess. But.
Yeah.
So that's it. Definitely just look for resources. That's the biggest thing. Listen and read as much as you fucking can. That's the last thing I want to do.
Investigate.
Investigate.
Yep.
You hear about something in the news and you're like, I wonder if there's value in that. Look into the natural gas market. Just learn about it. Just learn about it just to learn about it.
Yeah, exactly. And again, no pressure to try to invest positively in the market. When I say positively in the market, what I'm talking about is investing in the market, hoping things will go up. Thank you very much, Forrest. Round of applause for Forrest. Just keeping again just in mind that as far as valuations are concerned, here maybe I can look at. Well, you know what? No. Here, I'll do this one. So this is the Nasdaq. Okay, right. And it's just keeping in mind that for right now, valuations as they are concerned, right? When you see skyrocketing like that, and I've shown you guys the Warren Buffett indicator, I've showed you guys the Q ratio, I've showed you guys the Case-Shiller, price earnings ratio, and it's just not good. It just really isn't. So if there was ever a time to be hesitant, right, about trying to invest positively, hoping things will go up, now's not that time. But you can learn. You've got a good solid, based on history, good solid, like year and a half at least, to be able to learn this stuff, and that will inform you for the future. So right now, don't be so pressured for investing. You want to short stuff, then hey, that's a cool idea too. But you have to learn some stuff about that. So if you have interest, hey, hit me up. We can talk about shorting and a little more about that, and what we can look for, those sorts of things. But at the very least, though, right now is a brilliant opportunity to start looking into what you can do. You are confronted with this opportunity and this information, and what you will do to that will impact the rest of your life for decades to come, because of the nature of compounding interest. That you actually got into it, because most people will start looking at the stock market because they just never taught about it, not until like their 30s or 40s or something like that. And it's like with a 401k, and it's like, oh yeah, guess what your money's doing? It just goes right into the company, because they buy their own stocks and shit like that. And it I've seen that happen to people and shit, and it's bullshit. But so now is that time to at least start investigating, and it will pay off, I promise. All right, thank you guys very much for coming or showing up and listening and looking at stuff on the screen, my face and his face and the other dude's face. It was off camera, but you know he's there, that sort of thing. All right, thank you. Goodbye.